So you want to live off dividends. It's a pretty big dream for a lot of people to be able to get paid passive income on your investments and be able to do whatever you want. Dividend investing is a very powerful and attractive investment strategy. The thought of being able to pay for at least some or even all of your expenses through dividends and not having to work a full-time corporate job is a dream for many. Imagine being paid $100,000 or even $200,000 in dividends every year. You would basically be getting an unlimited supply of free money for the rest of your life, assuming of course that your investments don't tank. But there's a major challenge with this. Getting your investments to the point where you're making $100,000 or $200,000 a year in passive income through the form of dividends requires a serious amount of capital saved. To put simply, if you want to make $100,000 in dividends every year, you would need at least a $2 million stock portfolio that's paying a 5% dividend yield. You would also be paying taxes on these dividends as well. So if you wanted more dividends paid out every year, you would need even more investors. Needless to say, it's pretty discouraging for a lot of investors because getting to a point where your stock portfolio is worth that much is almost unrealistic for a lot of people, especially when you live in a high tax Western country like America or Australia. Like, let's say you're someone who's earning $150K a year in Australia, which is already a pretty high salary. You'd be taking home $98,494 a year after taxes. Now, if you manage to save 10 to 20% of your income, it would take you at least 40 years of saving just to get to the point where you're even close to making $1 million. In fact, you wouldn't even get to $1 million because you would only have saved up $784,000. Even if you were incredibly frugal and you managed to save 40 to 50% of your take-home pay by just eating beans and rice all day, it would still take you over 20 years to save up $1 million. Now, I know you're probably thinking that you could reach $1 million a lot sooner if instead of just saving, you actually consistently invested throughout this time. But even then, it would still take several decades. For example, if you wanted to grow your stock portfolio to $1 million, you would need to consistently invest at least 2.2K every month over the next 20 years. Again, this is achievable, but for a lot of people living in a high tax country, this isn't really possible. Now, let's say you're someone who's 20 to 35 years old and you've managed to save up 10 grand and you decide to buy a high dividend paying stock like Johnson & Johnson or Commonwealth Bank. Both Commonwealth Bank and Johnson & Johnson have consistently raised their dividends for the last 30 years, with the exception of last year due to the pandemic. Along with the stock price appreciation in both companies, it's a no-brainer that these companies, in my opinion, would be a pretty solid long-term investment, especially for someone who's looking for continuous dividends. So that's it. You know that this investment will continue to grow and you can just sit back and relax and forget about it while you look forward to a more prosperous future with income paying dividends. But then it becomes clear that Commonwealth Bank and Johnson & Johnson only have a dividend yield of 2.5%. In fact, Commonwealth Bank, which is currently trading at $95.57 a share at the making of this video, means that you're only making about $2.50 a year for every share that you own. That comes out to a little over 20 cents a month for every share that you own in Commonwealth Bank. With Johnson & Johnson, you'd be getting about 30 cents a month for every share that you owned. If you had invested $10,000 into either of these companies, that would be enough to earn about $250 a year in dividends, which is a little over $20 a month in passive income. Earning $20 a month after saving up enough money to go on a really nice holiday or buy a decent used car doesn't really sound like a great deal, does it? But the key point behind this investment strategy is that both companies are likely to raise their dividends every year. So you just need to have enough patience as both of these companies raise their dividends, which you can then reinvest and buy more shares as time goes on. If you wanted to predict future dividend increases, you could also look at the company's dividend history. And that makes you realize that both companies have consistently increased their dividends every year. For Johnson & Johnson, it's an increase of about 6%. And for CBA, it's an increase of about 2%. A dividend calculator will allow us to view how much money we will have in the future using this investment strategy. Using our example with Commonwealth Bank, it's actually a bit tricky to estimate, given that last year they actually slashed their dividend payout. But we would estimate that after 40 years, your investment would be worth just under $40,000. If you did decide to reinvest those dividends by not spending a single dollar of those dividends on yourself, like a nice holiday, a new car, or just everyday expenses, every year for 40 years, your investment would now be worth $64,858. Now, it's important to recognize that this doesn't just apply to Commonwealth Bank and Johnson & Johnson. Let's take a look at some other high yield dividend stocks. Here we have the other banks on the Australian Stock Exchange. ANZ, which is currently paying a 3.8% yield. NAB, which has a 3.4% yield. And Westpac, which has a 3.5% yield. And in America, there's Procter & Gamble, which has a yield of 2.5%. The 3M Company, 2.9%. And finally, McDonald's, which pays a 2.2% dividend yield. And so on and so on. I know that you can continue continue to buy more shares and reinvest those dividends over time. But the problem is that you also get taxed on those dividends as well. This means that your investment returns are going to take a really long time to accumulate. And the ability for you to invest your money into a portfolio that's going to be worth millions of dollars and pay out a decent annual income every year in dividends won't be achieved for several decades until you're significantly older. I don't know about you guys, but I don't want to be waiting around for 4 decades until I'm grey-haired and frail to actually start enjoying my hard-earned money. Not to mention the fact that this strategy only works if you're young. If you're in your 60s, 50s, or even 40s, you don't have enough time for these investments to grow. So this strategy only really works if you either already have $1 million saved up, or alternatively, if you're still in your 20s and willing to sacrifice the best years of your life by living extremely frugally, so that you have enough time for these investments to grow. Knowing this information causes a lot of young people to abandon this investment strategy and instead adopt far riskier investment strategies, like chucking all of their life savings onto bloody Dogecoin in the hopes of getting a 10,000% return on investment in such a short period of time. I don't know about you guys, but putting my life savings onto a speculative investment that's basically just gambling in my opinion, just so then you can acquire enough capital in your 20s to then be able to invest in dividends is an extremely poor investment strategy. And I know there are other types of crypto like Bitcoin and Ethereum, but again, these cryptocurrencies have already experienced huge increases anyway. To get a similar return like that on Bitcoin would basically mean that Bitcoin would now need to go to $1 million. What that means is that if you are someone in your 20s, you either have to grind it out and sacrifice the best years of your life just to be able to live off passive income when you're significantly older and almost on your deathbed, or alternatively risk all of your life savings on a speculative investment just to be able to get your capital up to an amount that is actually going to pay significant dividends. So with that being said, if you want to start making a significant income from your dividend portfolio now without having to gamble your life savings on something speculative just to get big returns, it's clear that you're going to need to target other investments. Obviously, this is going to involve researching and finding companies that are paying higher dividend yields. But this is also challenging because you have a lot of companies that are dividend traps. Like for example, MYER, which owns a whole bunch of retail stores in Australia, and at one point was paying a 10% dividend yield. But its share price has gone down by 80% in the last 5 years. And in 2017, they stopped paying dividends altogether. The covered call ETF is called QYLD, which currently has a dividend yield of 12.46%, and that's paid monthly. The fund buys stocks on the NASDAQ 100, like Facebook, Amazon, Nvidia, and then also sells or writes corresponding call options on those same investments. To understand why this ETF pays such high dividends, you need to understand how options work. Let me explain. So let's say you have two people, person A and person B, who have different views on where the share price of Apple will be in the next 30 days. The share price of Apple at the making of this video is $127. And person A thinks that in 30 days time, Apple's share price is going to drop to $120. Person B, on the other hand, thinks that this isn't going to happen. So they make a bet. Person A gives person B $2 to place the bet. If Apple's share price does not drop to $120 in 30 days, person B gets to keep the $2. If Apple's share price drops to $120 at 30 days, person B has to then pay person A an agreed amount when making the bet. The size of this amount is dependent on the options contract or the agreement that's made between person A and person B. Now that's actually a very simple explanation, and options are far more complex and advanced. But you can basically think of QYLD as person B in this scenario, except it's not just now one stock, it's for the top 100 stocks on the NASDAQ. And they're making these bets each and every month. The money that they make on these monthly bets is then paid onto investors in the form of dividends. However, it should be noted that this is extremely risky, and you can lose a lot of money by selling option contracts. Because technically, not only could the price of Apple drop to $120, it could also drop to $0, meaning that person B has to actually then pay more and more money to person A. The lower Apple's share price continues to go and fall beyond $120. Now, if you care about capital appreciation though, then this fund probably isn't for you. It's only able to consistently pay out monthly dividends because of selling these option contracts. As you can see, the price of the ETF hasn't really done much over the last 2 years. There's also another fund which is called RYLD, which is basically the same, except it's for the Russell 2000 index. Now, if you don't live in the US and you're looking to purchase something similar, then one option for Australian investors is the BetaShares Australian Top 20 Equity Yield Maximizer Fund, ticket symbol YMAX. This fund pays dividends quarterly, and at the moment it has an 8% dividend dividend yield through a similar covered call strategy. This means that if you had $10,000 in savings, you would be able to buy 454 shares of QYLD. And as I mentioned earlier, this fund pays a 13% dividend yield, meaning that your 454 shares in QYLD would pay you 1.3 grand a year or $108 a month. I don't know about you guys, but getting $108 a month in the form of passive income is certainly a lot more motivating for me to save and invest compared to just receiving $20 a month if I invested that money in Johnson & Johnson or Commonwealth Bank. Again, this isn't financial advice, but I also just want to say that investing in single stocks can be an extremely risky investment strategy. Unless you are really well diversified, you're basically trusting the board of that company to not be reporting fraudulent or creative accounting techniques. And this is why I like ETFs so much, because it's basically just a basket of the top stocks within the share market. With QYLD, if you consistently reinvest those dividends over a 10-year period, you would have $33,945 saved up. And if you had consistently reinvested those dividends over a 40-year period, you would have over $1.3 million. Having $1.3 million at retirement age certainly sounds like a much better deal for being so diligent and frugal compared to only having $64,000 in savings from reinvesting my money in single stocks at a lower dividend yield. Now, if you think that this fund is too risky because they're selling options, there are many other investment products that you can research, like business development corporations or BDCs. These provide financing to small and medium-sized distressed businesses. Companies that receive the loan are then required to pay back a portion of their profits back to the BDC, which in turn then passes these profits back to shareholders in the form of dividends. One of the highest yielding BDCs is ticker symbol CMFN, which is traded on the NASDAQ and has a dividend yield of 14%. There are a whole bunch of other investment products that pay high dividend yields as well, including real estate investment trusts, emerging market government bonds, and closed-end funds, among others. I'm going to make some more in-depth videos about these specific funds, so please subscribe to the channel if you want to find out more. The bottom line is that if you want to start living off dividends earlier in life, you need to ask yourself whether you're willing to grind it out and live extremely frugally for the next 40 years. If you're only willing to invest in blue chip companies that, in my opinion, only provide a pretty low dividend yield. Otherwise, you need to gamble all of your life savings on a speculative investment, just so you then have a small chance of receiving a 10,000% plus return on your investment, and then have enough capital to then start making some decent dividend yields. But in my opinion, it's worthwhile exploring option C, high yield dividend investment options, if you do want to live off your dividends faster. Thank you so much for watching this video. If you got some use out of it, I would really appreciate it if you liked, commented, and subscribe to the channel. I really want to get this channel monetized before the end of the year, but to do that, I need over 1,000 subs and 4,000 hours of watch time to get there. Thank you so much for watching, and be sure to check out my other videos as well.